Hello students, I am Dr. Simi Khurana from Ajay Kumar Garg Institute of Management. Today I am going to discuss financial derivatives unit 2nd and my topics are future contracts, traders, order type and difference between forwards and future. There are the three types of the traders. One is hedger, second one is the speculators and the third one is the arbitrators. I am going to discuss one by one all of them. The first one is a hedger. Hedgers are such kind of investors who wants to minimize their risk. Their intention is to minimize their risk, their intention is not to make a profit. How they can do that thing, I will explain with the help of an example. Suppose there is a person or the investor named Ram. And his intention is to minimize the risk. How he can do? Intention to minimize the risk. Actually, on the shares which he has in their portfolio. Let us take he is having the cash holding of shares of State Bank of India. Cash holding, Ram is having the cash holding of State Bank of SBI and State Bank of India shares at a price of rupees 540. And he is very much worried about this thing. If the market will come down, then there will be the loss. But if the market will go up, there is no problem, there will be the profit. But if the market has come down, then there will be the loss. Then what he has to do? He entered into the future contracts, but he is sell the future. He sell the future at a price of rupees 542. Due to the certain reason, the market is showing the bearish trend and the price of the State Bank of India is right now share at the rupees 530. There is a loss of how much, my dear student? It's 540 minus 530, that is there is a loss of rupees 10 here. But Ram wants to reduce their risk. How he can do? I have already told you that he is going to sell the future, short the future. When he has short the future, if the price will come down, they will get the profit. Opposite is going to be happened. Now, if the price of the future at that time, say rupees 532. No, it's 35. Let's say take an example of price 35. Now what is the difference between this one? There is a profit of rupees how much? Rupees 7. But the actual loss to him is rupees 10. If he is not going to take the future position, that is the opposite future position, he is having the cash holding of the shares of the State Bank of India in his portfolio at the price of 40. Now the market is showing the downward trend and the market will come to the 530 and there is a loss of rupees 10. But if he is not going to take the position of selling the future, then his total profit is of rupees 10. But now he has taken the future position, opposite position, and he has short the future. Now the price of the total profit he is gaining by shorting the future is rupees 7. Then the loss is going to be reduced by rupees 7. Now what is the intention to reduce the loss? He is reducing the loss by rupees 7 and the total loss is how much? 10. There is a difference of 10 minus 7. Now the total loss is only rupees 3. and this is written here. The person who undertakes such position is called hedger, and they are going to take the future market. ठीक है, movement in the price of securities, it may commodities, exchange rate, interest, what kind of the things they have, there must be the change, and he is going to take the opposite position, which I have already told, hedging, and he is going to follow the hedging strategy. If he is having the cash holding, he is going to short the position. Now come to the next one. First, this is explained with the help of an example also. A treasurer of a company knows that the foreign currency amount to be received at a certain future time may hedge precautions the foreign exchange risk by taking the short position in the future market. He can take a long position also, ठीक है, in case of future foreign exchange payment at a specified future date. A trader can take both the situation. He can take a long position also, he can take a short position also by following the hedging strategy. Now the speculator. What is the main aim of the speculator, my dear student? Its main aim is to earn a profit only. He entered into the market to earn a profit. His intention is to earn a profit only. His intention is not to minimize the risk. His intention is only to earn a profit, and he can do so by entering into the contract. He can buy the contract, he can short the future, he can sell the future, he can long the future also. If he will find out that the market is showing the bullish trend in the coming year, then what he will do? He will buy the future. But in other case, if he will think that the market will going to show the downward trend on the fundamental analysis or the technical analysis, then he will short the future. In both the cases, the main aim of the speculator is to earn the profit. The speculator forecasts the future economic condition. Future economic condition, let us take an example. If the monetary policy is going to be declared by the RBI governor in the coming month, then what will be the impact on the cash reserve ratio or the statutory liquidity ratio? On the condition of that, they are going to take a decision and they are going to buy or sell the future. Another way is, if the fundamentally he will find out that the price of the stock or the price of the share is undervalued, it is going to be increased with the passage of time, then what will he will do? He is going to buy the future. But if he will find out that the price of the share is overvalued, then automatically it has to come down. Then what the speculator will do? He is going to sell the future. And another thing which the speculator do, he can take any position, buy or selling, on the basis of the technical analysis also. A technical analysis, there are the certain charts which are showing to tell us that the market is showing the bullish trend or the bearish trend. Sometimes it's happened that Nifty is showing the bearish trend. In spite of that, some of the companies are showing the bullish trend. They are the this is the case of the defensive shares. Defensive shares means the market is negative, no doubt the market is showing the bearish trend and index is showing the bearish trend. Certain people are going to short the future of the index, but the certain people are having the long position. Long position means they have a long position in other sectors, just like defensive share, just like a Dabur, Marico, they are the defensive shares. Sometimes the market is showing the downward trend, but these shares are showing the upward trend. The speculator can take a position of the long in that share which are showing the upward trend, and they are going to take a short position those where they are seeing the downward trend. And this is also given in the question. A speculator forecasted the price of the gold would be rupees 1500 per 10 grams after 1 month. Now the current price of the sugar is 54. He is expecting that the price is going to be increased, but it may be increased, it may be decreased. It depends on the market situation. suppose he has entered into the market at the price of rupees 5400 per 10 gram. It means rupees 5400 per 10 grams. It means he has long the future. Long the future. Long future. It means he has buy the future on the expectation that it will going to be increased, but due to the certain problem something is happened in the market and market is going to show the downward trend. Instead of 5500, the price is right now rupees 5300 per 10 gram. Now there is a loss of how much? There is a loss of 100 rupees. There is a loss of 100 rupees because 53 rupees 54, 53, there is a loss of rupees 110 per gram because he is long the position, he is having a long position. Long means he is thinking that the market is going to be increased, bullish trend is there, but there is a bearish trend in the market, that's why there is a loss of 100. But if the reverse is going to be happening, that means the price is showing at rupees 56 after some time, then there is a profit of how much? The profit is 5600 minus 5400, then the profit is 210 per grams. The main motive of the speculator is to earn a profit, and it can be done through the fundamental analysis, it can be done through the technical analysis. I have already explained this thing. If the speculator find that the shares of the companies are undervalued, then what is going to do? He is going to buy the future. But if it is overvalued, then he is going to sell the future. Moreover, the technical charts, which are very important these days, our market is doing the trade on the technical analysis. We can buy the future, we can sell the future on the basis of the certain candlestick pattern. If the bearish trend is showing in the technical chart, it means if the bearish encliffing are shown in the technical chart, we are going to sell the future instead of buy the future, because the speculator only find out the profit and profit. There is no need to he is not thinking about the losses, but it doesn't mean that there is no loss to the speculator. The speculator can maybe suffer a losses also, but their main aim, their main intention is to earn a profit. In the spot market, a speculator has to make an initial cash payment, but in the future he has to do the trading by paying the initial amount only. A speculator who uses the fundamental analysis of economic condition of the market is known as fundamental analyst, and the person who is going to judge the performance of the stock on the basis of the past performance, that is known as a technical analyst. A speculator who owns a set on a particular exchange and trade in his own name is called a local speculator. Then arbitrator. The main intention of the arbitrator is to earn a riskless profit. Arbitrator is a trader who attempts to make a profit by locking in a riskless trading by entering into the transaction in two or more market. Arbitrator keeps the future and the future price in line with one another. There is one good example which is given here. Suppose that the price shown in the future price, we can write down future price is rupees 600 right now, and the spot price of the stock is rupees 580. Now the arbitrator enter into the market, and what he will do? He will short the future. Short the future. Short the future at what price is rupees 600. And when it will come to the 580, he will come out with the profit of how much? Only 20 rupees per lot. It means he is getting a profit. The main aim of the arbitrator is to get the profit out of the two markets. ठीक है, here the two market, one is a future market and the second one is a sport market. In the case of the future, the price is 600. In the case of the sport future, the price is 580, and there is a difference of 20. And what he will do? He will short the future and will come out at the 580 within a certain period of time. So this come under this category, arbitrators. The example is also given here. At the expiration of the gold future contract, the future price is how much? 5500 per 10 grams. But the spot price is how much? It is 5480 per 10 grams. An arbitrator purchased the gold for rupees 5480 per 10 gram and go short. Go short means he is going to sell the future and expiry immediately and make a profit of rupees 20 per 10 gram by delivering the gold for rupees 5500. Arbitrary trading help to make a market liquid, ensure accurate pricing and enhance the price stability. Next one is the types of order. There are different kinds of orders. Right now I have discussed only limit order and the market order. Limit order means whenever you are going to buy any future, you have to place a limit there. Again, there is an example. If the future price is right now in the market relating to any share is rupees 700, okay? Now, if you want to buy at the 700, you can easily enter the price at 700, then you will get the future in your portfolio. But the same thing is not happen in the case of the limit price. In the limit price, if the future price in the market is right now 700 and you want to purchase the future at 680, then what you will do? You will have to put the limit. You will write down 680. It means when 680 will come, then the future is going to be executed. Market order, the investor is prepared to trade at the current market price which is given and place a market order with their broker and pass to the commission broker representative. Two-sided limit order, you have to define the limit and request the transaction to be exercised only at the specified price or better one is obtained, otherwise not. And my dear student, limit price is never equal to the spot price. It may be less than or it may be more than. It doesn't mean that whatever the market price, the limit price is the same. Market price means the price which is prevail in the market right now, the future market price, but in case of the limit price, it may be less than or more than. You can take an example. If the price of the share right now, the future price is 500, then your limit price should never be 500. It may be 498 or it may be 520 or 510. It means it may be more than or less than, and I will explain with the help of example. This is a type of order and the limit is given. I am going to trade with the options. Suppose CNX Bank is the bank nifty. This is the option of 6 October 39,000. I am going to take the call. And right now there are the two again option, that is buy and sell. As we know that in the case of the options of the bank nifty, the lot size is 25. It means the number of the total share, that is 25. And the order type is this is a limit order and this is a market order. If you are going to put the limit order means 422. Right now the market order is 422.20, but right now here the limit order is 422.05. It means it is less than market order. It may be more than or it may be less than, but it should not be same. If it is same, then it becomes the market order. You have to choose any one of them. Either you have to put the limit size, or you can do the trading by through the market order also. Now next topic is the difference between the forwards and the futures. The first one is the trading. My dear student, we know that forwards are the customized contract. Forwards are over the counter contract. Forwards can be done through the telephone also, but in the case of the futures, it can be done through the particular exchange. The second one is the size of contract. As forwards are the customized contract, the buyer and seller can decide anything relating to the price, quantity and the date. But in the case of future, it is not, it is standardized contract in cash future market. Then price of the contract, in the case of the forward, the price of the contract remains fixed. Whatever they have decided in advance, it remains fixed at the time of the delivery also. But in the case of future, the price of the future is going to be changed within a seconds. Then margin. In the case of the forward contracts, there is no need to pay any margin amount, because at the time when the forward contract is formed, it's a there is no need to pay any cost. It is done through at the time when the delivery is going to be take place. But in the case of the future, you have to pay the margin. There are the different kinds of margin: initial margin, variation margin, maintenance margin. In this question, in the simple form, we can say you have to pay the initial margin first. Counterparty risk is very much high in the case of the forward contract, but in the case of future, the counterparty risk is not there. Then number of the contracts in a year. In the case of the forward contract, the number of contract is unlimited, but in the case of future, it is fixed. Then frequency of the delivery. 90% of all forward contracts are settled by actual delivery. Very few future contracts are settled through the physical delivery. It is only through the cash delivery. The next one is the hedging. As we know that the forward contracts are the tailor-made, customized contract. It can be decided between buyer and seller. They can decide anything. But in the case of the future contracts, hedging is by the means of month and the quantity contract, so it is not a perfect. Liquidity, there is no liquidity, my dear student, in the case of the forward contract, but in the case of the future contract, very high liquidity is there. Nature of the contract: over the counter, over the trade, OTC contracts, and this is the standardized contract. Mode of delivery, specifically decided. Most of the contract result in delivery, and futures are the standardized contract, and most of the contracts are the cash settlement there. In the case of transactional cost, costs are based on the bid and ask spread, but in the case of the future, it's only include the brokerage fee for buy and sell the orders. Now I am going to end the lecture. Today we have discussed number of things relating to the different types of the participants in the future market, that is the hedger, speculator and arbitrator. Then we discussed about the types of order. We have discussed only two types of order, that is the market order and then the limit order. Then we have discussed in detail about the futures and the forwards. Thank you very much.